Okay, for about the last 25 years, we've all been told the exact same story. You know the one. It's this simple, super seductive promise of getting rich, and it all starts with your morning coffee.
I mean, you've heard it a million times, right? It's everywhere in best-selling books, you see financial gurus preaching it on TV, and it's become this go-to critique of younger generations. The idea is that if you just make these small, daily sacrifices, they'll magically compound into a fortune. Okay, but what if the entire foundation of that advice is just a myth?
Because that is the real question, isn't it? The whole latte factor story just completely falls apart the second you compare that tiny, optional expense to the massive, unavoidable costs that are just, part of being alive today.
And check this out. This is some bombshell data straight from the Federal Reserve. I mean, look at this. For Gen Z, just 1.2% of their income goes to coffee. 1.2%. Meanwhile, a staggering 48%, almost half, goes directly to rent. The numbers do not lie. These two things aren't even in the same universe. It's not even close.
And that right there, that's the whole problem. This isn't just bad advice, it's a dangerous distraction. It's designed to make people feel guilty about their spending habits while totally ignoring the huge economic pressures that are the real issue. So today, we are going to bury this latte factor myth for good using actual data. And then we're going to map out a much more realistic path forward.
So to really get why this advice is so wrong now, we have to go back to where it all started. Let's take a quick trip back to the late 90s.
The whole concept was born in 1998, and you have to understand, it was a totally different financial world back then. The stock market was on fire. The S&P 500 was averaging an 18% return every year. And here's the kicker. The average rent was only about 25% of a person's income. In that specific environment, yeah, the math sort of worked.
Okay, so let's fast forward. How does that old formula hold up today? Well, it doesn't. This comparison says it all. Back then, rent was about a quarter of your income. Today, it's almost half at 48%. And those crazy 18% market returns, forget about it. The average over the last 20 years is a much more modest 9.8%, and that's before you even factor in inflation. The original math is just completely broken. It doesn't apply anymore.
So here's the bottom line. Continuing to push this outdated advice isn't just unhelpful. It's a form of financial gaslighting. It makes you feel guilty for the symptom, buying a coffee, while completely ignoring the actual disease, which is this fundamentally more expensive and challenging economic world we're all living in.
So if it's not the lattes, what's the real villain in this story? Well, the data points overwhelmingly to one culprit, the housing trap.
Just look at this stark comparison. When boomers were buying their first homes, the price was, on average, 2.8 times their yearly income. For Gen Z today, that ratio has skyrocketed to 6.7 times their income. This has nothing to do with poor planning. It is a massive, systemic, generational disadvantage.
And you know what's pouring gasoline on that fire? Student debt. For Gen Z, that debt burden pushes back their ability to even start saving for a home by an average of 7.2 years. So what does that 7.2-year delay actually cost someone? Well, the Urban Institute estimates it costs over $220,000 in missed equity growth. That is wealth that a previous generation was able to build that's now just locked away behind a wall of debt and inflated prices.
Let's be perfectly clear. You cannot budget your way out of this. You can't skip enough lattes to overcome a system that is actively extracting wealth through crippling housing costs and student debt. The coffee was always a decoy, meant to distract from the real issues. Okay, so the old map is useless. Let's throw it out. What does a new, realistic map look like? This is where we shift from the problem to actionable solutions that actually work in today's world, without the guilt. We're going to look at 3 evidence-backed strategies that tackle the real financial challenges head-on: controlling your biggest expense, optimizing how you pay off debt, and building wealth outside of the traditional system. First up, rent hacking. The goal here is simple. Attack your single biggest expense, which for most of us is housing. The target is to keep that rent payment below 35% of your income, whether that's through housemates or by finding cities with better renter protections. This can free up some serious capital. Take Maya's example. She saved $750 a month, which grew to $42,000 in 3 years. Now that is real money for investing, not just coffee money.
Second is the debt hybrid method. This is all about being strategic, not just frugal. You attack your debt aggressively when you get a windfall, like a bonus or a tax refund, while using auto-investing apps to make small, painless contributions from your regular income. It's a much more balanced approach, and federal data shows it helps people pay down debt 2.3 times faster, without the burnout of constant penny pinching.
And third, if the traditional housing ladder is broken, build your own with portable equity. This means finding assets that can grow and move with you. You could use inflation-protected I-bonds, look into rental arbitrage, where you legally sublet a property for a profit, or even own a piece of a building through tokenized real estate platforms for as little as $50. It's all about creating wealth outside the old, inaccessible system.
Now, these strategies are powerful tools for navigating the current reality, but personal finance is only half the story. To truly fix the problem, we have to look bigger.
And this slide shows that bigger picture perfectly. The financial struggles in the U.S. aren't inevitable. They're the result of policy choices. Look at Germany, where rent control helps keep housing costs down. Or Denmark, where college is not only free, the government actually pays you a stipend to go. This isn't about culture, it's about political priorities.
So the crucial point is this. Personal responsibility is important, of course it is, but it cannot be the only part of the conversation. Real, lasting financial freedom will only come when we stop blaming individuals for struggling in a broken system and start demanding that we fix the machine itself.
Which brings us to our final question. We spend so much time teaching people how to budget and save within the existing rules. But why aren't we also teaching them to question the rules themselves? Why are we taught financial literacy but not systemic literacy? Thinking about that might just be the first step to rewriting the rules for everyone.